Just this week, Randgold Resources reported a 41% drop in net profit, and that's largely been attributed to the fall in the gold price that came through over the period. It averaged $1,195 an ounce over that period. And Mark Bristow, CEO of Randgold Resources, joins me now at the Investing in African Mining Indaba 2015. Thanks so much, Mark, for your time today. So has that drop in the gold price been your biggest challenge?
No, not at all. I think you're doing us a disservice to start with that drop. Rather look at the other side, is that a substantial earnings delivery, a 26% growth in production, we've regrown our balance sheet, $100 million on the balance sheet, no debt, and more importantly than anything else, we replaced all the ounces that we mined in 2014 at a long-term gold price of $1,000. So that's the good news.
The good news is that you're one of the players that's been able to remain profitable over the period. As you say, increased production 26%. You succeeded in reducing cash costs as well. That's down a further 2%, sitting at $698 an ounce. So what more is in your control to get things swinging back in the right direction?
Well, the most important thing in cost management, and we've taken, we're efficient, and I always say if you've got lots of costs to cut, then why did you have them in the first place? But I think we've shown that we can improve our logistics and supply chain and become more efficient with the amount of working capital we tie up in our business. Grade is a king when it comes to unit costs, and grade we're still forecasting to improve, and so we are still forecasting a steady drop in the total cash costs of the company. And the other significant thing is that we've come to an end of a big capital investment phase, and we're now got a good solid 5, 6, 7 years of harvesting that investment. So our capital's coming down, our production's going up, and our costs are coming down, and that results in much more cash flow. Mm-hmm. And you would have seen that we also increased our dividend by 20% in a time when the industry is really struggling to make ends meet.
Well, at a time as well where you've emphasized you've got $100 million sitting on your balance sheet in cash, no debt on your balance sheet as well. To what extent have you changed your tune on finding your own projects rather than buying them?
Not at all. As you saw, the first thing we did, as we did in '99 when the gold price went the wrong way through $300 an ounce, is that we really looked at our core R&D, our exploration team. We spent and we announced that reinvention of ourselves, to coin a phrase, last year, middle of last year, with a change and restructuring of the team, refocus in our future. And we've, over the last 2 years, consolidated our footprint by mopping up a lot of struggling juniors in our exploration efforts. I think so we're very committed to discovery and development. The point is you can't predict that. The flip side, as you've heard me talking for some time now, is the opportunity that this really dynamic market might or might not bring, and that is M&A. And we've seen, in stressed situations, you saw, I don't know if you listened to the Nedbank presentation, there is no debt available. All the vulture lenders are now on the block, and royalties are not even working anymore, and that's the last in the cycle. And I think the industry's got to look at reinventing itself, and with that will definitely come opportunities. Whether they fit our investment criteria is another question.
Of course, you've been quoted saying conditions will have to get worse before you see any deals actually worth doing. While that brings growth opportunity for you, as highly indebted companies restructure to survive, does that potential not make you nervous that things will have to get worse?
No. If you look at how we created Randgold Resources back in the 90s, it was in a similar environment. Everyone felt that the gold industry was toast and it had no future. And out of that time came Randgold Resources, came the very significant successes like Goldcorp and other companies. Of course, a lot of the large companies from then are now the medium to small companies of today.
Yeah. Okay, while you have the muscle to withstand the financial stress regime that you're facing right now, you've said that government needs to catch a wake-up call on the impact of failed mining industries. Do you think that's starting to hit home?
I believe so. I think, there's never been more open communication, frank communication between governments and miners right now, because, whenever you get into trouble, you always start speaking. And that's a natural thing in any partnership, so, and I think that's a positive sign. I think I'll just come back. We don't intend to just survive in this market. We're going to survive and grow. We are well positioned to be able to continue to deliver
Where
value.
are you continuing to grow? You've got operations, of course, in Mali, the Ivory Coast, and the DRC. Where are you looking to extend that footprint?
Well, we replaced the ounces we mined last year through a new feasibility study. We announced a new underground project in Western Mali. We've still got a lot of potential in the whole Loulo-Gounkoto region. We're really growing our footprint in the Côte d'Ivoire. We think it's a great destination. It's got a new mining code that's really, attractive to investment. We've got the Massawa project in Senegal that we're busy, struggling to get through our filters, but it's still a good project. And then, of course, the KZ zone in DRC, which hosts Kibali and is host to another 10 million ounces of resources, is equally prospective, and we would like to see that our footprint in that region expand into some of the neighboring countries as well.
Well, let's leave it there, Mark. Always a pleasure. Thanks so much for having joined us and catching up with us right here at the Investing in African Mining Indaba 2015.